Hello and welcome to this webinar conducted by ACCA for the financial management exam that is commonly regarded as FM or F9. Before formally starting this webinar, what I'm going to do is that firstly, I will give you a brief introduction regarding what exactly this webinar is all about, because there are many people who are messaging with curiosity that what exactly we are going to cover in this and what do we plan to do in this particular webinar. So initially, I will firstly brief you regarding what are our plans in this particular webinar, guide you how to discuss question and answers with me, and then we will formally start this. It would just take 3-4 minutes for a brief discussion. Okay, now this webinar, as we all know, is related to financial management, commonly regarded as F9 exam. Before starting this webinar, I would like to specifically thank ACCA for giving me this opportunity to arrange this webinar. And believe me, this is going to be very helpful for students, because what happens is that students are about to give exam, and before the exam, they just need a brush up of their concepts. They just need a quick revision. They just need on how to get the tips and tricks in some important areas. So these webinars in the past have usually been proven to be very helpful for students, and we would also request you to give feedback after the end of the webinar that whether you people are finding these webinars good or not. Okay, now as we all know, with respect to financial management, that in financial management exam there are basically 6 core areas. Okay, the first core area is basically called investment appraisal, a usual part of section C question. Okay, the second core area, weighted average cost of capital, commonly regarded as WACC. Okay, the third core area, business finance, or commonly regarded as sources of finance. Okay, next core area, that is risk management. Okay, dealing with currency risks, dealing with interest rate risks. This is specifically the risk management area. Okay, then area called business valuations, how to value a business. This is the fifth core area, and the last area is related to working capital management, related to inventories, receivables, and stuff like that. So these are basically considered to be the core areas of F9 financial management exam. And obviously people are preparing these so they might be familiar with this. Okay, that these are the core areas of the financial management exam. Now, as far as the webinars, what exactly are we going to these webinars? Okay, now before starting this webinar, I would firstly like you all to understand some basic stuff, that how things are going to proceed. Okay, now since this webinar is being conducted online, when an online class is being considered or conducted, you must be aware that there are three things which must be perfect at your end. First, you must be able to clearly listen to the tutor, like whatever I'm speaking, you are able to hear me. Number one. Number two, you are able to see my video. Sometimes there is a problem in connectivity at students' end. So they say that we have paused the video, okay, hear me? Like clearly, like I hear with all of these things. So, because obviously when I will be solving the questions, it is very important that during solving questions, you are able to see what exactly I am doing, okay? Sometimes there can be problems at my end, sometimes there can be problems at your end, but obviously in 99% cases, if problem is at my end, everybody faces problems.
हाँ आपकी थोड़ी सी हो रहा था बीच में तो अगर देखें आप फिर ट्राई करें आप
Okay, are you able to hear me clearly now?
मतलब सही है बेहतर है चला सकते हैं मतलब बिल्कुल परफेक्ट नहीं है
Okay,
इंटरनेट अवेलेबल है आपके पास तो आप
मैं कर लेता हूँ चेंज. Okay, मैं कर लेता हूँ. Okay, sorry for the voice trouble. I was saying that in case there is any connectivity issue from my end, obviously the ACCA team is also readily available. If they find any distortion from my end, they immediately inform me and we immediately rectify it. However, there are sometimes problems at students' end. Okay, so rather than improving the problem at their side, what they do is that they constantly send messages in chats. I'm unable to hear anything, I'm unable to hear everything, resulting in disturbance of the other 120 students. Okay, so remember, if there is going to be a problem at my end, it will be resolved in seconds because team ACCA, my team, they are ready with the backups. So don't just start flurry of messages if the problem is at your end. Ensure your connectivity issues, everything is perfect. Okay, during the lectures, if you have any questions from me, you might be needing to ask some questions from me. Okay, so if you're seeing this go to webinar tab, on this go to webinar tab, there is a portion of questions. Okay, there is a portion of questions, so you can go on this questions, and when you will go in that questions and ask any question, I will reply you for this question, but obviously not immediately. I may have to complete my statement, I may have to complete the question part which I'm doing, and then when I will say you, okay, now I'm answering questions, you can always ask the question, and I will be quite happy to assist. Okay, one last thing, there are many questions at the moment that whether this webinar will be recorded. Okay, so I think team ACCA has already informed, and if you haven't got that information, let me inform you that the team ACCA is going to record this webinar and they will share the link with you, and when they will share the link, I will also forward them to you, they will also forward them, so you can view this webinar later in recorded form as well. Okay, so no need. What we are going to cover in this webinar, one last thing. Okay, now obviously there are 6 topics as I've mentioned in course of financial management. What we are going to do is that in these 4 days, in these 4 days, Monday, Tuesday, Wednesday, Thursday, these 4 days, we are going to try our best to cover as many topics as we can. Investment appraisal, weighted average cost of capital, source of finance, business valuation, risk management, working capital. We are trying to cover as many areas as possible, but don't worry. In case if any particular area is not covered due to shortage of time, obviously, you know that the course is big and we just have 12 hours. So if any area is not particularly covered in this particular 4-day session, you don't have to worry. We will shortly be making a WhatsApp group, and I will share that WhatsApp group link with all of you. You can join that. And the topics which have been missed or we are unable to cover in this particular webinar, I will share with you extra videos of those topics so that you can cover. So you can make sure that if you attend this 4-day session and you also join the WhatsApp group, and the videos 2, 3 I will share with that, you will cover all 6 areas in this particular session, as well as 1 or 2 extra videos which I will provide you. So don't worry, we will cover all the core areas. Okay. In this core areas coverage, remember, this is a practice to pass session. You know the title and name of this session. This is practice to pass. We have to practice. Practice what? Past exam questions. This is practice to pass, practicing exam questions. So for every topic, we will be trying to practice 2 past exam questions in every class, so that at the end of this, you are done with at least 10 to 12 past exam questions practice. And remember, past exam questions practice before the exam helps you sufficiently to clear the exam. Okay, so let's start. We are starting with the topic number 1 today, that is investment appraisal, and we will try to cover 2 past paper questions of investment appraisal of recent attempts, practice to pass, practice and practice. Okay, what you're going to do is that there is a questions portion in this tab. There is a file of questions in that. You need to download that file. I am going to show the question on the screen as well, but obviously you must be needing that question on your own reading or for your own reading as well. So there is a questions tab as well, and sorry, handouts tab as well. In that handout, there is an FM file of day 1. Please download it. In the meantime, I will share a WhatsApp group with all of you, and then we will start. Okay. Team ACCA, and you of that first on the WhatsApp group number 1. Okay, number 2, we can discuss question and answers with this particular in this particular group. Students face some question issues, they can ask me, they can get help from other students as well. Okay. And thirdly, as I said, if some topics are left and we are unable to cover that, so definitely we will be doing providing you videos of that particular topics as well. Okay. So I think we should now start. Every one of you has I hope downloaded that day one documents file. Okay. May I request the team ACCA to please share the WhatsApp group link, because students are asking. They will shortly be sharing that WhatsApp group link, and they have in fact shared as well. So make sure you are joining this group. And no matter if you don't join it immediately as well, you can join it later as well during the break after the session. I would request the team ACCA to share it every hour, so that students who are joining late, they can also get this WhatsApp group link. Let me share it with you guys again, because some people are saying they are unable to join it. Okay, from my side also, I have sent the group, and those who are saying they cannot join, they need to wait later, because almost 50-60 students have joined the group, so there might be some problem at your end. Try it later. I think cannot wait further. We should start now. Okay, and don't worry, I will provide it to you later as well in the break and stuff like that. Don't worry about it, and stop messaging regarding this WhatsApp group. We will join it later. Okay. So let's start. Okay. So the handout file, which you all might have downloaded, there are questions in this file, which we are going to attempt in our sessions. And remember, I'm going to show these questions on the screen as well, but the file has been shared just to make sure that you guys have a sound idea that we have the questions at our place as well. Okay, so let's start. And as I told you that the topic we are going to do today, that topic is investment appraisal. So the questions we are going to do is mentioned here in the file. And I have just requested students that if WhatsApp group is not joined, please wait patiently. We have told you multiple times that you will be provided the group link later, and if anyone is unable to join, we will sort your issue in the break. We cannot just spend our 10, 15, 20 further minutes on just the WhatsApp issue. Many people have joined. If anyone has any problem, we will help them out. Okay, so specifically I would request students not to send further messages with respect to WhatsApp group. Okay, now when you were going the exam, And obviously your exam is a computer-based exam. I'm closing this file. This file has been provided to you. Okay. When you will go in the exam and you will open your exam, this is how a typical exam structure will look like. This is how a typical exam structure will look like. That the first page of the exam would be like this. Financial management. This is written September, December 2020 exam. Your attempt would be, for example, June 2022. So it will be written June. It will be first instructions on the first page. Get to know your exam. Okay, so you need to read these instructions. Then you will go to page 2 of the exam. Okay, these are also introduction videos. You must carefully read all these instructions in the exam. We are not wasting time on this. Okay. Then you can see the third page is the general instructions, answering and navigating, flag for review. This is mentioned, so you will be reading those instructions as well. Then there is another page of instructions that if you need help, you should click the help button. Then calculator, where is the calculator? Highlight and strike through, working and scratch pads. Every instruction is given. If you want to go in the exam and not spend time reading that, you can always open the past papers on ACCA website and read these instructions. Still instruction screen, see how to copy and paste, symbol, navigator screen, close all, reviewing the exam. Every instruction is given. This is the last instruction screen, item review, ending the exam, clicks next to continue to exam summary screen. Okay. Then it will come with exam summary screen. Time allowed, you know what is the time allowed in the exam. So constructed response question is worth 20 marks. All questions are compulsory. Click next to start your exam. You will click next and start your exam. And this is how the question will come. This is question number 1 of this exam, spine company. Okay. This is our typical exam structure with rubric. It will give you a scenario. After scenario, there will be requirement and requirement with a spreadsheet screen. Obviously, calculation requirements are solved on spreadsheet. Part B, as you can see, it's a theoretical requirement, so it will be not a spreadsheet, but a Word file where you can type your answers. Requirement C is also a non-calculation, therefore, has given a word. I'm not stopping here because we are not going to do this question. Question number 2. This is the question which you are going to attempt. This is the question from September, December 20 exam. And in this September, December 20 exam question, we are going to cover investment appraisal to it. We are going to cover investment appraisal to it. Okay. So I have opened the exam screen just to tell you and make you all familiar with the thing that what exactly the examination screen looks like. And then we will solve it on the spreadsheet. Okay. So this question we are doing, it's a past exam question, and through this we will be attempting investment appraisal. Okay, let's start. I'm reading it. If you want to read from the screen, you can read from the screen. If you want to read from the handout which I have provided to you, you can read from the handout. Okay, let's start. This scenario relates to 4 requirements. This is a question from December 20 attempt of ACCA. This scenario relates to 4 requirements. The scenario has 4 requirements. Okay. Crockett Company is a manufacturing company that has 3 investment decisions for the coming year. Crockett Company is a manufacturing company that has 3 investment decisions for the coming year. Okay. Investment decision 1. Investment decision 1. 6 investment projects are being considered with the following details. 6 investment projects are being considered with the following details. Okay, so you might be seeing in investment decision 1 that there are 6 projects being considered with the following details. 6 projects are A, B, C, D, E, F. If you can see, project A requires initial outlay of 1 million and the NPV is 390,000. Okay. Project B requires initial outlay of 1.5 million or 1500,000. NPV is not yet known. Project C's initial outlay 750,000, NPV 325,000, D 1125 and 590, E 1845 850 and NPV is 840 and F is 1300 and 635. Okay. Now out of all 6 projects, you can see project A, C, D, E and F. All projects NPV is given, but project B's NPV is not given. Okay. Now, since project B's NPV is not given, you should be familiar and prepared that it will ask you to calculate project B's NPV. See, project B is expected to generate the following cash flows. Now, project B's cash flows are in year 1, year 2, year 3, year 4. The sales income is given 725, 765, 885 and 612,000. And project B's year 1, 2, 3, 4 cost is given. From this, I got to know that project B has a life of 4 years. Okay, project B has a life of 4 years. And project B has a life of 4 years. Revenues and costs of all 4 years are given. Now it's written that project B's cash flows are before allowing for inflation of 4% per year for the sales income and 5% per year for the costs. Now project B's cash flows are before allowing for inflation. They have not yet been inflated. 4% per year on sales income and 5% per year on costs. Okay. Crockett has a nominal cost of capital of 10%. Crockett has a nominal cost of capital of 10%. Obviously, when inflation is there, we know there are 2 types of cash flows, real and nominal. Real are without inflation, nominal are with inflation. Okay, so when inflation is given, you use a nominal cost of capital that's given. Due to management's reluctance to raise new finance, capital for investment in the above projects is currently restricted to 5 million. Capital is restricted to only 5 million. Capital restricted to 5 million means we are facing rationing as well. Capital rationing as well. Rationing, shortage, only 5 million is available. Projects A, B, D, and F are all independent, but projects C and E are mutually exclusive. A, B, D, F are all independent, but C and D are mutually exclusive. All of the above projects are divisible and none can be delayed or repeated. Okay, so all these projects are divisible and none can be delayed. Okay, so let's basically first gather some data. As you can see in this Crockett company question, I'm just taking some data for the purpose of ease of understanding. There are 6 projects with us. A, B, C, D, E, and F. Now, to save time, you saw I directly copied the data from the question rather than typing. This is allowed in the exam. You can do this. Copy the data from the question and copy it on your spreadsheet to save time. Okay. So basically, what is happening here is that there are 6 projects under consideration, and all projects NPV and all projects investment has been given to you. Okay, B's data is not yet known. Okay, go back to the question. Now project B is expected to generate the following annual cash flows. We have got the cash flows of project B year 1, 2, 3, 4, 725, 765, 885, 612 and cost 145, 168, 202, 294. B's cash flows are before taking account of inflation of 4% per year on sales income and 5% per year on costs. Okay, nominal cost of capital is 10%. Capital for investment in the above projects is currently restricted to 5 million. Okay, capital available is restricted to 5,000 or 5 million. Okay, capital available is restricted to 5 million or 5,000. Okay, and A, B, D, and F are independent, C and E are mutually exclusive, all projects are divisible. Okay, so one last thing. All projects are divisible and C and E are mutually exclusive. Okay, all projects are divisible and C and D are mutually exclusive. Okay, this is what the information was. I have completed the investment decision one. See, I have completed the investment decision one. That the question told me that Crockett is a manufacturing company. It has 3 investment decisions. Investment decision one, 6 projects under consideration from A, B, C, D, E, F. 1 project's NPV was not given. Then B's cash flows were given, and the projects are divisible and mutually exclusive. Okay. Investment decision two. A number of Crockett's employees have a company car. Okay. A number of Crockett's employees have a company car. The entire company car fleet is now due for renewal, and in the past it has been replaced every 4 years. Management are not sure if this is the optimum length of time and feel that other replacement cycles such as every 3 years or 5 years should also be considered. So number of Crockett's employees have a company car, entire fleet is due for renewal, has been replaced every 4 years. Management are not sure this is the optimum length, feel that other replacement cycles such as every 3 years or 5 years should also be considered. This is investment decision 2. And investment decision 3. The management of Crockett are considering the financial viability of another project, but as yet no detailed financial information is available to perform an NPV appraisal. The investment decision 3 is that the management of Crockett are considering financial viability of another project, but no detailed information is available to perform an NPV appraisal. One of the reasons for this is that the various cash flows will be subject to a number of different rates of inflation that are very uncertain at present. For example, the selling price inflation may be no more than 2% per year, whereas material cost could be 4 to 6%. The general rate of inflation is expected to differ from both of these. Management are not sure whether appraisal could be performed by simply ignoring the inflation altogether. Now, considering this investment decision 3, read the first line. The management of Crockett are considering financial viability of another project, but no information is available to perform NPV. No information is available. One of the reasons is that various cash flows will be subject to number of different rates of inflation, which are uncertain. Selling price will be 2%, material cost 4 to 6%, general inflation will differ. Management are not sure whether appraisal could be performed. Note, the 5 million capital constraint outlined with investment decision 1 applies to that investment decision only and not to investment decision 2 and 3. A very important note. You see that 5 million capital was restricted in investment decision 1. The note states it applies to that investment decision only and not to investment decisions 2 and 3. That means when making any decision regarding investment decision 2 and 3, the 5 million constraint does not need to be considered. Okay, this ends the data. Now what happens with the requirements? Requirement A, for investment decision 1, only focus on investment decision 1. Calculate the net present value of project B. We have to calculate the net present value of project B. 4 marks. And given the capital constraint, calculate the optimum investment combination and resulting NPV. So first you need to calculate the NPV of B, 4 marks. Given the capital constraint, calculate the optimum combination, 6 marks. 10 marks is this requirement, and read requirement again. This is for you would be wasting your time if you are looking at requirement, because this requirement is clearly mentioned in 1. Only focus on investment decision 1. Calculate the NPV of project B. Okay. And given the capital constraint, calculate the optimum investment combination. Okay. I will only look at investment decision 1 and solve this requirement. Since this is a calculation requirement, the spreadsheet will be provided to you in the exam, as you can see. And if it would be a theoretical requirement, then only a Word file would be given. Okay, so let's start. Okay, just a quick recap of things. When you're talking about the section of investment appraisal section can ask you to calculate NPV, can ask you to calculate IRR, can ask you to calculate ROAS, return on capital employed, and can ask you to calculate payback. This is what your financial management course states. You can be asked to find NPV, IRR, ROAS, and payback. Then you can be asked to undergo a lease or buy decision. You can be asked to undergo an asset replacement decision, and you may be asked to undergo a capital rationing decision. Okay, this is the whole investment appraisal of your syllabus. And finally, you can be asked to perform sensitivity analysis and probability analysis. Now, if we talk about this question is covering a very important area. It's firstly asking you to calculate NPV of project B, and then it has stated that capital is rationed to 5 million. 5 million is available, shortage. Make the optimum investment schedule. Now, when you might have studied the optimum investment schedule in NPV during your studies, in capital rationing decision, we have to make an optimum combination. There are two types of projects. Sometimes projects are divisible and sometimes they are indivisible. Divisible means they can be taken in proportions, 50%, 60%, 70%, and indivisible means can only be taken in full, never in proportions. Okay. So in this question, the capital is rationed to 5 million. It's asking for optimum combination investment and projects are divisible. Okay, so we will perform both of these. Firstly, for investment decision 1, we are going to calculate the NPV of project B and then optimum investment combination. Okay, again saving time. I will copy data from the question. I'm doing the first part. Calculating the NPV of project. Okay, let's start calculating the NPV of project B. Let's start calculating the NPV of project B. Look at the data. Project B is expected to generate the following cash flows. Sales is given 725, 765, 885, and 612, and cost is given 145, 168, 202, and 94. Okay, so in the next line, project B's cash flows are before taking account of inflation of 4% per year for sales income, 5% per year for cost. Crockett has a nominal cost of capital of 10%. Okay, we will calculate NPV of project B. Now, if we calculate NPV of project B, first we should make the columns. There is a 4-year life, so we will make 0, 1, 2, 3, and 4. 4-year life, so we will make columns 0, 1, 2, 3, 4. And we all know with respect to NPV, because appraisal is usually believed to be the easiest areas of financial management, we will record all the inflows and outflows. We will record all the inflows and outflows. Okay. Now, if we talk about project B, Firstly, project B requires some investment. Firstly, project B requires some investment. Investment is usually conducted at year 0 and it's an outflow. So what is the investment being done in project B? 1,500. So we will record negative 1,500. This is an outflow. This is an outflow. Investment of 1,500. Okay. Once we get the investment figure, which is basically believed to be an outflow, then we start recording our inflows. So what are our inflows? As you can see in the question, there are some sales and there are some costs. So sales are 725, 765, 885 and 612. So I will write 725, it's in year 1 inflow, then 765 inflow, then 885 and 612. 885 and 612. Okay, this is sales. And then project B is incurring some costs. Cost is an outflow. So what are the costs in year 1, 2, 3, 4, 1, 4, 5, 1, 6, 8? These are outflow. 1, 4, 5 negative, negative 1, 6, 8, negative 202, negative 94. 1, 4, 5, 1, 6, 8, 202 and 94. Okay. If there are any further cash inflows and outflows, you must record them. But at the moment, it seems there are no further cash inflows and outflows. Investments NPV has to be computed. The life is 4 years, so 0, 1, 2, 3, 4. Investment was 1,500. It's always at year 0, so negative 1,500. We got sales and then we got costs. Now, if you continue just like that, there will be a big problem. Okay. Because the question states that project B's cash flows are before allowing for inflation of 4% per year on sales income and 5% per year on costs. Project B's cash flows are before allowing for inflation of 4% per year for sales income and 5% per year for costs. So as far as this particular question is concerned, it's a significant thing that you are asked that project B's cash flows are before taking account of inflation, 4% per year sales and 5% per year for costs. We have to inflate them. Let's inflate the sales because it's 4% per year for the sales. So year 1 sales is 725. Pay attention to the working. You can show the working separately or you can show the workings in these cells as well. Year 1 revenue is 725, right? They are before inflation of 4% per year. So in year 1, inflation is 4% per year. Would inflationary impact come one time? Yes. So you should inflate it by 4% per year. So one time inflation. Either you can increase it by 4% and add it, or directly multiply it with 104%, because if you multiply by 104%, it becomes 104%, increases by 4%. Okay, 754. Similarly, year 2 figure is 765. Pay attention to the working piece. Year 2 figure is 765. Okay, if you know the formulas in the cells, you better see it if you don't know it, because you can get the information clearly. Now, year 2 figure is 765. It's before taking account of inflation. It's before taking account of inflation. Okay. But now it's year 2 figure. Inflation is 4% per year. So if you multiply it with 104%, this just brings the inflation impact one time, because you increase it by 4%. 4% was per year. Since it's in year 2, you need to inflate it by 104% 2 times. So into 104% into 104%, the value would be 827.424. Either you can do this. I'm opening it again. 765, obviously 4% per year. So you need to apply inflation 2 times because it's year 2. In year 1, we applied 1 time. In year 2, 4% per year per year. Okay, so when inflation needs to be applied in year 2, it's 4% per year. So we have to apply 4% per year 2 times. So either you can do is into 1.04 into 1.04, or what you can do is, please see at the screen, into 1.04 power 2. Because if you do into 104% power 2, it takes the inflation to 2 times, 827 again. Okay, please pay attention. Now year 3 figure is 885. Year 3 figure is 885. So it's 885 is before taking account of inflation. Now inflation on sales is 4% per year. So to get to year 3, 4% per year means you need to inflate it by 4% 3 times. Into 1.04 104%, into 1.04 104%, into 1.04 104%, 3 times. This gets the figure of 995.5, or what you can do is 885 into 1.04 into 1.04 into 1.04, rather doing this 885 into 1.04 power 3 brings the inflationary impact 3 times, same value. And similarly, year 4 figure is 612 before taking account of inflation. It's 4% per year. So to get to year 4, we need to inflate it 4 times because it's 4% per year. So 1.04 power 4, 715.95. Okay, just a second, pause. Any questions with respect to inflation you can ask, then I will move to costs. Okay, so the questions are, before inflation means what? From Salman Abdul Rahman. Before inflation means inflation hasn't been considered. Okay. Fazan, your question is a very basic question. How much zeros? Okay, so obviously I'm ignoring zeros. So 725, 754, 827, they're without zeros. Okay. Salman Abdul Rahman, your question again, is it yearly inflation? It's clearly mentioned 4% per year. So what does per year means? It's obviously every year. Okay. Fatma, I am unable to understand your question because you have just written sir. So what is your question? Okay, now let's just move towards costs. Let's move towards costs. Now, cost in year one was 145. Cost in year one was 145, and it was before taking account of inflation. Inflation was 5% per year. So for year one, you need to inflate it by 5% one time into 105%. This makes it 152. For year two, the cost was 168. Okay, but cost inflation is 5% per year. So to go to year two, you need to inflate it by 5% two times, either into 1.05, 1.05, okay? Or what you can do is into 1.05 power 2, 185. Third is 202 before inflation, okay? So to incorporate inflation, we need to inflate it 5% per year three times into 1.05 into 1.05 into 1.05 or power 3. And year 4 is negative 94, 5% per year. So to make it 5% per year, it's 4 years, so into 1.05 power 4. Okay, this I have inflated the cost figures. Any questions with respect to cost? Okay, Aisha, as far as your question is concerned, this is a mathematical technique. If you want to increase something by 10%, either you take 10% and do addition in the previous figures till you get the same answer, or you directly multiply it to 110%. So 110% means you are increasing it by 10%. Both approaches give the same answer. Okay, so once we have investment and sales and cost, there was no information apart from these cash flows from project B, because if there had been any other cash flows, we would have taken them as well, but only these cash flows were given. So now what we will do is, when you are sure that there are no other cash flows, you net them all to get net cash flows. So net cash flows of year 0 seem to be 1500 negative. And for year 1, we will take the difference. Once you get the net cash flows, you multiply these net cash flows by the discount factor. Pay attention, since you have applied inflation in revenue and costs, now if inflation is applied, the rule states you have to use a nominal cost of capital. So nominal cost of capital is 10%. So from the table provided in the exam, we will use the discount factor 10%. Year 0 factor is 1. Year 1 factor from the table is 0.909. Then 0.826 for year 2, then 0.751 and 0.683. Okay, net cash flows, when they will be multiplied by discount factor, it will give you present value. Net cash flows, when it will be multiplied by discount factor, it will give you present value. So multiply them 1500 into 1. And so when you have the present values, you need to net them all to get the NPV. To net them all, we will sum all cells, sum of investment cell, that is E23 till I23. All these cells will be net off and NPV will be 560 positive. This is the NPV of project B. Our 4 marks requirement is done. You can copy this. If you have any questions, you can ask, then we will move towards requirement 2. Okay, Mohammad Abbas Khan, as far as your question is concerned, isn't it better to show inflated sales and cost in working? There is no standard pattern. Whatever is better, it's for you. So if you are comfortable with them, please use that. If you are comfortable with something else, doesn't matter about that. Saifullah Khan, all workings. Okay, please copy it quickly so that we can move to the next part. Hassam Muhammad Ashraf, this is the working which I have shown. This is sufficient. Ahmad Hayat, you can ask Team ACCA regarding it when it will be uploaded. Yes, Noman, I will share the files of these solved questions. Iman, I will answer your question when we will be doing part C of this question. Don't worry. Lian Heather, if my NPV is 560.4 and yours is 561, it is not any problem. Yes, Aman, you can do that. Amna, there is no requirement of decimal places, 2 places, 3 places, rounding off, everything is allowed. Hamza, this has been told by ACCA multiple times. They will share recordings. Don't worry about it. The WhatsApp group has become a very serious issue in today's class, because as I'm seeing 70 people have joined and 3 or 4 people are saying that it's not working. So I don't know what's the problem. So that's why I told that it's better that we leave this issue at the end. Okay, let's move towards requirement B now. If anyone is unable to copy all stuff, I will share this file on the WhatsApp group after the class is over. Don't worry about it. I will share this Excel file with you. Okay. Okay, now as far as requirement A2 is concerned, again, copy that from the question that given the capital constraint, calculate the optimum investment combination and resulting NPV. Okay. Now, if you look at the question, please pay attention. The question was that there are 5 projects under consideration, A, B, C, D, E. Okay, 5 projects under consideration, A, B, C, D, E, F, sorry, 6 projects under consideration. The initial outlay was 1,000, 1,500, 750, 1,125, 1,850, and 1,300. And NPVs were given. Initial outlay was given and NPV was given. Okay. For project B, the NPV was not yet known, but now we can remove this. We now know that the NPV of project B is 560, right? I hope there is no confusion with respect to this. That if you read the question initially, six projects A, B, C, D, E, F were under consideration. Outlays were given, and with outlays NPVs were given, but project B NPV was not yet known, so we have now found it 560. Okay, because the cash flows were given. Now, an important thing is that only 5,000 is available with the company. Now, if you see company is facing capital rationing, if you see company is facing capital rationing, how? If you just see, there are 6 projects under consideration, A, B, C, D, E, F. All have positive NPV. There are 6 projects A, B, C, D, E, F. All have positive NPV. So basically, the liking would be that we should opt all projects. What do you think? If there are 6 projects, all are having positive NPV, we should opt all. But just check here. That project A requires funds of 1,000, then B requires 1,500, C requires 750, D requires 1,125, E requires 1,850, F requires 1,300. So if we add them all, the outlay required is sum of B29 to B34. You require 7525. You require 7525. That's a problem. That A, B, C, D, E, F, all projects have a positive NPV, right? So your wish would be taking all projects. If a company has all opportunities with positive NPV, it should take all. But the funds required are only 5,000 and you need 7,525. This is what we mean that we face capital rationing. This is what we mean we are facing capital rationing. And in capital rationing, you should accept one thing. It is not possible to take all projects. In capital rationing, it is not possible to take all projects. How can you take all projects? You have only 5,000 available. But the projects which are under consideration, they require 7,525. So you cannot take all projects. In that case, you have to make the best combination, that is called the optimum combination. That's what it is asking. That calculate the optimum combination or best combination. Okay. Now, in our F9 financial management syllabus, it states that when projects are divisible, and you are facing shortage, to make the optimum combination, what you should do is you should calculate the profitability index of each option, which is NPV over investment. Okay, this is what financial management studies say, that when you are facing shortage of cash, see, I'm facing shortage of cash, I require 7,525 to fulfill all projects. I only have 5,000. This is shortage. I cannot take all projects. Right? Because taking all projects requires 7,525. I don't have that. So I need to make a best combination, that is called the optimum combination. How will you make it? Our studies say that if projects are divisible, it's important to find the profitability index of each option. How do you get the profitability index of each option? NPV over investment. So find the profitability index of each option. Project A, profitability index, NPV is 390 over investment is 1,000, 0.39. Profitability index of B, NPV 560 over investment 1,500, 0.37. Profitability index of C, NPV 325 over investment 750, 0.433. Profitability index of D, NPV 590 over investment 1125, 0.52. Profitability index of E, NPV 840 over investment 18, 0.45. And profitability index of F, NPV 635 over investment 39. You get the profitability index of each. Okay. Once you have the profitability index of each option, the next step is you must rank all projects based on their profitability index. So which is having the highest profitability index? 0.52 first, then second, then third, then fourth, then fifth, and then sixth. So the scenario is calculate the optimum investment combination. I gave you background about optimum investment combination, that what was the background about optimum investment combination. The background was that there are 6 projects under consideration. One project's NPV was not known, so we calculated it. So when 6 projects under consideration all have positive NPV, we should go towards all of them. But the problem is we don't have enough cash. All projects require investment of 7,525. We only have 5,000. This is shortage. Except this, you can never ever take all projects in this case. It's not possible. Okay, so you have to make an optimum, best combination. Optimum means best. For divisible projects, this is done via profitability index, NPV over investment. It's basically NPV to investment ratio. So you calculated profitability index of all NPV over investment. And on that, you did ranking. Now, once ranking is made, you know which is the first one, which is the second one. You now should make an optimum combination. How? Pay attention. Put three headings: projects, investment, NPV. Three headings: projects, investment, and NPV. Projects are A, B, C, D, E, F. Okay. Ranks are 5th, 6th, 4th, 1st, 3rd, 2nd. Inject funds in this order, keeping in mind the investment limit is available only 5,000. Keeping in mind the investment limit available is only 5,000. Okay, let's start. What is the first rank project? D. What is the first rank project? D. So inject funds in D. What is the first rank project? D. So inject funds in D. How much funds D require? D requires 1125. Inject 1125. Since we have 1125 at the moment, we have 5,000. So we need D first. It requires 1125. We have that. Inject 1125. Since you have injected whole amount in D, you will get whole NPV. What is the whole NPV of D? 5. Okay, repeat. When optimum combination is to be made, projects are divisible, find profitability index of all, assign ranks. After ranks, you know which is the first one, which is the second one, then inject funds in that order. How to make the optimum combination? 3 columns: projects, investment, NPV. 6 projects, ranks are there, inject funds in this order. Keeping in mind the investment amount is 5,000. So first rank is D. I will put money in D. D requires 1125 outlay. Do I have 1125? Yes, I will put in D. Okay, I will put in D. Full amount has been invested, so full NPV. Okay. Now, what is the second rank? F. Put money in F. How much F requires? How much F requires? F requires 1,300. Since you have 1,300, keep an eye on the amount. 5,000 was available, 1125 was spent in D. Now F requires 1,300. Do you have 1,300? Yes, you have 1,300. Put 1,300. Since you have invested full amount in F, you get full NPV. What is that? 635. Keep an eye on the amount. 5,000 was available, 1125 went in the first one, 1,300 went in the second one. What is the third rank? E. What is the third rank? E. How much E requires? E requires 1850. Do you have 1850 with you? Yes. 5,000, 1125 was spent, 1,300 was spent. You still have money. So inject 1850 in E. Have you invested full amount in E? Yes. Full amount means you will get full NPV. That is 40. What is the fourth one? C. You injected first in D, then second in F, then in E, and the fourth rank is C. C requires how much? 750. C requires how much? 750. You might have had 750, but the problem is it's mentioned C and E are mutually, it's mentioned C and D are mutually exclusive. Mutually exclusive means they cannot be taken together. If two projects are mutually exclusive, it means they cannot be taken together. So since you have already taken E as the third rank, even if you have money for C, they are mutually exclusive, you have taken E, you cannot opt for C. You cannot opt for C because both of them are mutually exclusive. Okay, mutually exclusive means you cannot take both of them together. So if you have taken E, the third one, you can never go for C even if you have money because they're mutually exclusive, cannot be taken together. Ignore C. Now, after fourth one, where you should go? Fifth, A. A requires how much investment? 1,000. A requires how much investment? 1,000. But if you see, you had 5,000 with you. The first one was occupied by D. 1125 was taken by D. Then you went to F. 1,300 was taken by F. Then 1,850 was taken by E. So just keep an eye. 5,000 cash was available. 1125 was taken by the first one. 1,300 by the second one. 1,850 by the third one. So you're only left with 725. A requires investment of 1,000. A requires investment of 1,000. You don't have 1,000. You only have 725. Since they are divisible, divisible means can be taken in pieces. You can invest 725 in A, but 725 invested out of required 1,000 means you only took 72.5% proportion of A. So in A, you can only do investment of 725, but investing 725 out of remaining 1,000, available 1,000, required 1,000 means you only took 72.5% share of A. So you won't get full NPV of 390 from A because you haven't invested full money. You have invested 72.5% money, 72.5% share is taken, so you will only get 72.5% NPV. And 72.5% NPV is 282.7. All cash is finished. So for B, the sixth one, no money left, no investment, no. So how much NPV you are getting by investing this 5,000? Add all this becomes 2,347.75. Okay, this ends your 6-mark requirement as well. That calculate the optimum combination. We have made the optimum combination and we have also found the resultant NPV. The resultant NPV is 2,347. Okay, copy it. Any questions, please ask. Why is the ranking of project E is better than C? So we will take that. No, Nishika, in indivisible, there is another approach. Jawad, you can link the cells as well as you can calculate the value and put in cell, but in that case, you need to show the workings. Fazan, this sounds a very strange question that do we have to show working of optimal plan having lower NPV? No, it's not required. Salman Abdurrahman, mutually exclusive means both projects cannot be taken together. Yes, in indivisible, we use trial and error method, and those who have difficulty in that, they can contact me after the class. We will ensure a solution for them. We will provide a video to them as well. Don't worry, Amir. Ali, this is not possible that a question which has been made of divisible, you can just change that question and make it indivisible. Obviously, it's a separate thing. Hamza, I apologize. There are hundreds of questions, so you can also retype your question. Yes, Sanallah, if you're showing workings in a cell, no need to show workings separately. Sanallah, what you have written is correct, that you don't have to show workings separately. Yes, Hassan, in 5-10 minutes, we will be doing that. Which functions are allowed, which are not? There is an examiner report regarding these workings. You can read that. Yes, Irshad, you're right. Okay, there are obviously people who want that an area which is problematic for them, that is discussed out of context as well. I really apologize. It is not possible because then we won't be able to cover all areas of the syllabus if we start answering each and every individual query. But don't worry, that's what the purpose of the WhatsApp group is. That's what the purpose of making the group and sharing the personal numbers is. That in case you find difficulty in any area and by chance that is not covered in these 4 days, obviously you also know that it's very difficult to complete the whole syllabus in just 12 hours. Okay, so if it is not covered, you can always contact me. We will be able to assist you out of the box regarding that. So there is absolutely no need to worry regarding this particular issue. And also it is a request, don't message that wait for 5 minutes, we are copying, or please, we are in a hurry, go to the next question. Okay, obviously there are 120 students in this webinar. I cannot follow the instructions of one particular student who says that increase the pace or reduce the pace. The class will be at a standard pace, and obviously I'm conducting, so it's better. What I like, it should be that accordingly. Okay, now we will do the next parts of this question, and after doing these parts, we will go for a short break for water, tea, and prayers, and then come back. Okay. Now, requirement B of this question is for investment decision 2. Explain the approach Crockett should use to determine the optimum replacement cycle. This is 4 marks, and this is relating to investment decision 2 only. Okay, so you don't need to see anywhere else, only focus on investment decision 2. Explain the approach Crockett should use to determine the optimum replacement cycle. Okay, I have the decision 2 in front of me. Just read the investment decision 2. A number of Crockett's employees have a company car. The entire company car fleet is now due for renewal, and in the past it has been replaced every 4 years. Management are not sure if this is the optimum length of time and feel that other replacement cycles such as every 3 or 5 years should also be considered. This is only investment decision 2 data, nothing else. So requirement B is relating to investment decision 2, which states that entire company car fleet is now due for renewal. In the past, it has been replaced every 4 years, but management are not sure that this is the optimum length, feel that other replacement cycles such as every 3 years or 5 years should also be considered. Okay. Requirement B is for investment decision 2, explain the approach Crockett should use to determine the optimum replacement cycle. I will not write the complete answer because you can read the examiner answers. I will just write the point. In asset replacement decision, what students are taught? That when you have to determine optimum replacement cycle, cash flows are not comparable. Not comparable means what is the issue? You are thinking to replace every 3 years, 4 years, 5 years. So cash flows won't be comparable because 3 years, 4 years, 5 years all have different lengths. All have different lengths. One is of 3 years, one is of 4 years, one is of 5 years. So when cash flows are of different lengths, they are not comparable. So to make comparison like with like, an approach called equivalent annual cost, you might have heard regarding it, EAC, is considered. What EAC does is, EAC is NPV over discount factor. It brings options of varying lengths on one level. EAC brings options of varying lengths onto one level. Like options of varying lengths means one option is of 3 years, one is of 4 years, one is of 5 years, one is of 2 years. So all these separate options are not comparable. So to make comparison like with like, we use an approach called equivalent annual cost, NPV, over discount factor, and option having lowest EAC is opted. This is what you should explain in requirement B, that explain the approach Crockett should use to determine optimum cycle. So you should write that in order to determine optimum cycle, the options will be always of varying lengths, like companies also considering 4-year, 5-year, 3 years. This will make sure comparison is not like with like. So we use an approach called equivalent annual cost, EAC. That's NPV over discount factor. The purpose of EAC is to bring options of varying lengths onto each equal level, so that comparison is like with like, and then option having lowest EAC is opted. These are just the sample points. You can write, note that, and I would advise you to read the official examiner answer as well on how to elaborate these points to get a 4-mark answer. Obviously, you can never write the complete examiner answer, but you will just read and get knowledge regarding elaboration. Okay, any questions in this? Yes, Assam, it is allowed. And Amir, I have told in the past as well that I will share these files. No need to worry regarding that. So Ahmed Mishal, discount factor and annuity factor, there is no difference in that apart from similar cash flows and uneven cash flows. There is no difference. Last part now, it's a very easy part, theoretical part, and then we will go for a break, short break. Now, I literally consider this question as a very mark scoring question, calculation wise as well as theory wise. Look at parts. Part C is in relation to investment decision 3, describe 2 approaches for dealing with inflation and provide a reasoned recommendation as to which approach Crockett's management should follow. Now in the 6 marks, there are 2 things. Describe 2 approaches for dealing with inflation and provide a reasoned recommendation as to which approach management should follow. This is a very mark scoring theoretical question because you might have studied that there are 2 approaches of dealing with inflation. One is called nominal approach and one is called real approach. There are 2 approaches of dealing with inflation: nominal approach, real approach. Nominal approach incorporates inflation in cash flows and uses nominal discount rate, that is discount rate having inflation, whereas real approach does not incorporate inflation and uses real discount rate, that is discount rate not having inflation. Okay, explain two approaches of dealing with inflation. So there are two approaches to deal with inflation: nominal, real. Nominal means inflation is not accounted for in cash flows. Nominal means inflation is accounted for in cash flows and we use nominal discount rate. Discount rate is also adjusted for inflation. And real, which does not incorporate inflation and uses real discount rate, not having inflation. So what first requirement was, explain two approaches of dealing with inflation. Recommend which management should follow. Obviously, you can write that as far as easiness is concerned, people will favor a real approach. As far as easiness is concerned, people will approach a real approach. No need to incorporate inflation, use real discount rate. Okay. But in this particular question, selling price, variable cost, everything has different rates of inflation. And when everything has different rates of inflation, it is very important to get a fair analysis of NPV, that all inflationary impacts are considered to get a fair view of NPV. So it's very, very better that when inflation is available, the preferred approach should be nominal. I would also suggest you that for this also read the examiner answer, okay, to get a fair idea. We have completed our first past paper question. It was a very mark scoring question, 10 marks for calculation and 4 marks how to take decision regarding asset replacement via EAC, and then two approaches of inflation and which it should use. Okay, we are taking a 15-minute break for prayers and tea coffee, and then we will meet with the next question. Okay, if you have any question with respect to that in this question, in the meantime you can ask. Hassam, I told that since inflation is a real world factor and everything is subject to inflation, and it's better we use nominal approach. And Hamza, both give same answer, but obviously if selling price is not inflated, variable cost is not inflated, then the person doing appraisal would not know what the revenue and what the variable cost is expecting. The final answer is the same, but sales and cost values in Okay, so we are now resuming, and before resumption, there are some questions asked by students. Let me address them. Hassam, yes, your statement is correct. And obviously, the break was not only for you guys, it was for me as well. I also had to pray and have a cup of tea, so I was not there as well. So many question marks. Sanaullah, I can't answer you this question that till when the recording will be ready, because it's to be announced by Team ACCA when you will get the recording. And Aisha, what are your questions? Aisha, it's better you contact me via WhatsApp because this is a very subjective question that which section is more important. We will talk about it. And here I told you that whatever you have missed, we will share with you the files on this WhatsApp group, so no need to worry. Now, the webinar question asking during this 3-hour webinar, it should be answered only here on the GoToWebinar tab. Now, if you will ask questions on WhatsApp group as well, and you will ask questionnaire as well, I cannot look at both of these places. So it's a request, please, that please ask questions there. Now, I think in our group, approximately 90 students have joined, but still there are few students who are having problems. So what I'm going to do is now, I have sent you all my WhatsApp number. Okay, so you just drop me a message that you are unable to join the group. I will add you directly. Okay, but do it after the class. Okay. Now, during the break, I was just going through some of the WhatsApp messages. Okay. In these WhatsApp messages, a student basically copied the theoretical stuff which I wrote. The theoretical stuff which I wrote. And others were making fun of him that this is too short, you will just score 1 mark. So obviously, I think some people are expecting that this is a full-fledged class, whereas this is a prepare to pass webinar, a revision sort of class. Okay. In a full-fledged class, we will type the complete answer, and after typing the complete answer, we will give to the students. Those who have studied from us in regular classes, they know. But obviously in a revision class, these are just points. You have to elaborate them. And that is why I told you all that once you have gathered these points, elaborate it and write the answer. And I also recommended you to use the examiner's answers, read the examiner answers. Okay. Because you need to at least mention 4, 5, 6 lines to gain 4 marks. Okay. Obviously, whatever I have written of nominal and real, these are also just points. You need to draft them properly. For that, you read the examiner answer as well. This will help you in detail. Let's move to the next question now. Now the next question we are doing, that's related to September, December 2021. And this is the latest past paper published by ACCA. So I have opened this particular scenario. And once I open that, there is the same, firstly, instruction screen. And you read the instructions, you read the instructions, you read the instructions, go down. You get the questions. And since we are doing investment appraisal, this is the question Hawker Company. I will show it on the screen as well. And you can also see it from the handout which you have. September, December 2021 question. Okay, so I'm reading this question. Please pay attention. The question states, Hawker Company is about to replace its existing delivery vehicle with a new design of vehicle that offers greater fuel economy. It estimates that replacing existing vehicle will save running costs of 2,000 per year. Okay. Hawker is about to replace its existing delivery vehicle with a new design of vehicle. So company is about to replace its vehicle with a new vehicle that offers greater fuel economy. Okay. And it estimates that replacing the vehicle will save running costs of 2,000 per year. So the company is basically trying to replace its vehicle. Company is basically trying to replace its vehicle. Hamza, I'm surprised. Weren't you attentive? It was nominal real which was discussed. So Hawker Company is about to replace its existing delivery vehicle with a new design of vehicle. It estimates that replacing existing vehicle will save running cost of 2,000 per year. So company plans to replace its vehicle. There are two financing options. So in replacement of vehicle, there are two financing options. Okay. Option one. Option one is vehicle could be purchased for 34,000. You can purchase the vehicle for 34,000 using a bank loan with an after-tax cost of borrowing of 4% per year. The vehicle would have a useful life of 4 years, would have a residual value of 14,000 at the end of that period. Straight line tax allowable depreciation, that is capital allowances, is available on the vehicle. The vehicle would be subject to a government CO2 emission tax of 600 at the end of each year of operation. Emission tax expenses are corporation tax deductible. Okay. Okay, so this is the option one, that vehicle could be purchased for 34,000 using a bank loan with an after-tax cost of borrowing of 4% per year. The vehicle would have a useful life of 4 years, would have a residual value of 14,000. Okay, and straight line tax allowable depreciation is available on the vehicle. Like we all know that tax allowable depreciation, also called capital allowances, it's on a straight line basis. So straight line basis means you take the cost 34,000 less the scrap value, that is 14,000, over life, that is 4 years. Okay. Okay. And vehicle would be subject to a government CO2 emission tax of 600 at the end of each year. Emission tax expenses are corporation tax deductible. So emission tax expenses are tax deductible. Okay. This is the option one. Option two, vehicle could be leased for a period of 4 years for a payment of 6,000 per year payable at the start of each year. So vehicle will be leased for 4 years. First option was purchasing. The second option was leasing for a period of 4 years for a payment of 6,000 per year. Payable at the start of the each year. Start of each year means advance. The lessor will pay the CO2 emission tax. We don't have to pay it. The lessor who is giving us the vehicle, we are lessee, we are taking. The lessor will bear the tax. This is not our cost. Lease payments are corporation tax deductible. Hawker's after tax weighted average cost of capital is 8%, and it pays tax at a rate of 20% 1 year in arrears. Ten marks calculation requirement. That's why a spreadsheet cell is given. Evaluate whether Hawker should use leasing or borrowing. So at the either you need to decide company should use leasing or company should use borrowing. Okay, either company should use leasing or company should use borrowing. Obviously there are two options, so we need to decide that whether company should use leasing or company should use borrowing. Okay. So if we remember this particular portion, that the question is stating for 10 marks whether Hawker should use leasing or borrowing. So there are two options, that Hawker is about to replace its existing delivery vehicle, and it's a new design offering greater fuel efficiency. The replacing existing vehicle will save running cost of 2,000 per year. There are two options. The first option is that company can purchase for 34,000 using a bank loan, and the second option is leasing. And straight line tax allowable depreciation is available. Vehicle would be subject to a government tax of 600 at the end of each year. Tax expenses are tax deductible. And option 2 is leasing. Tax rate is given as well. Okay, so there are two options, and you need to evaluate whether it should use leasing or borrowing. 10 mark requirement. I will answer this requirement. So I'm answering this requirement, whether Hawker should use leasing or borrowing. Now, what does NPV calculation say? That when you have to take decision between leasing or borrowing means buying, and you have to take decisions regarding leasing and borrowing, what you need to do is you have to find NPV of each option, and whichever option is giving the better NPV, you need to choose that. Okay, when you are deciding whether to lease or buy, so you need to find NPV of each option and then decide. Okay, so the first option is borrowing and buying. So I will find NPV of option 1. After doing this, I will find NPV of option 2 and then decide which is better. So let's find NPV of option 1. Pay attention. Now, what is option 1? Please pay attention. The vehicle could be purchased for 34,000. So it could be purchased for 34,000 using a bank loan with an after-tax cost of borrowing of 4%. Vehicle would have a useful life of 4 years, would have a scrap value of 14,000. Tax allowable depreciation is available. So tax allowable depreciation, you know, it's capital allowances and it's emission tax of 600. So let's find NPV of option 1. There is a 4-year life, 0, 1, 2, 3, and 4. Okay. What things are coming in buying option? Okay, vehicle, you are doing what? Purchasing. So purchasing will result in investment of 34,000. Outflow negative comes at year 0. Okay, then What does it mention? The vehicle would have a life of 4 years, would have a scrap value of 14,000 at the end of that period. So at the end of that period, it will be scrapped. Scrap is an inflow. 14,000 positive. Okay. Straight line tax allowable depreciation is available. You know, tax allowable depreciation results in tax savings. So you can make a tax allowable depreciation format as well. Your TAD or capital allowances tax savings at 20%. So it's a 4-year life, 1, 2, 3, 4. Every year tax allowable depreciation is how much? Cost less scrap value over life. It's 5,000 each year. And this depreciation of 5,000 each year will reduce profits by 5,000, resulting in tax savings of 20%. 5,000 into 20% is 1,000. So for each year, we will get a tax allowable depreciation of 5,000, resulting in tax savings. But since tax is paid in arrears, so year 1 benefit is going to come in year 2, year 2 benefit in year 3, year 3 benefit of 1,000 in year 4, and year 4 benefit in year 5. So for the capital allowances or TAD, it's every year from year 2 a benefit, 2, 3, 4, and we have to make year 5 as well. What are the other cash flows? Investment 34,000, life of 4 years, scrap value 14,000 inflow. Tax allowable depreciation, it's 5,000 each year, which reduces profit, so gives benefit of tax of 1,000 in arrears. Vehicle would be subject to a government CO2 emission tax of 600 at the end of each year. So it's a 4-year life, right? So at the end of each year, you have to bear an emission tax of how much? 600 negative. Four-year life, so 4 times you have to bear an emission tax of 600. And it states emission tax are tax deductible. What does this mean? Emission taxes are tax deductible. That means this is an outflow. It will reduce your profits by 600, so will result in tax benefit of 600 into 20%, 120 in arrears. Taxes in arrears, right? So 120 in later years. These are all the cash flows mentioned in the question with respect to option 1. I can put the information of option 1 in front of you because there are 2 options. You need to find NPV of each option. Purchase cost 34,000 outflow, scrap value 14,000 inflow. Tax allowable depreciation is straight line 5,000 each year, which reduces profit by 5,000, so reduces tax by 20%, 1,000. Emission tax of 600 outflow each year, and they are tax deductible, so they give tax benefit of 20%, 120. No other thing mentioned in option 1. Okay, I've written all the 5 cash flows in option 1. If you have any questions with respect to them, please ask. Shaban, it's depreciation, straight line basis. So straight line basis formula for each year depreciation is cost less scrap value over life. So cost was 34,000 less scrap value 14,000 over life, 4 years. So it's 5,000 each year. So 5,000, 5,000, 5,000, 5,000 is the tax benefit. Now, if you say that you are getting a benefit of 5,000 in depreciation, so this will reduce your profits by 5,000. And if my profits are reduced by 5,000, obviously profits reduced by 5,000 means you have to pay less tax. What is the tax rate? So less tax of 1,000. This is what tax benefit is. Similarly, there is emission cost of 600. Yes, sir, you are on point, Salman. Emission tax is 600 outflow, so it will reduce your profit by 600. Now, if your profit is reduced by 600, obviously you will get 20% saving. Take it like this. Take it like this. Your profit is, let's suppose, 10,000. Take it like this. For example, profit is 10,000. How much tax you have to pay? 20%. 2,000. Let's suppose depreciation came or emission tax came. So how much is the depreciation? 5,000 each year. If 5,000 depreciation came each year, then your profit fell by 5,000. From 10,000 profit due to depreciation, profit became 5,000. So now you have to pay 20% tax on 5,000 only. That's 1,000. So you see, depreciation reduced your profit and reduced tax by 1,000. This is what tax benefit is. Amna, your question is, can please it? I'm not getting. Sonal, if you want to show that way, no problem. What will happen? It will still show the same thing. Kasim, depreciation reduces the profits. If your profit is supposed 10,000, you have to pay 20% tax on that profit of 2,000. Okay. But since depreciation is 5,000 per year, so see your profit from 10,000 became 5,000. Reduced profit means you have to pay 20%, 1,000 reduced tax. So depreciation reduce your tax from 2,000 to 1,000. This is called tax savings. So Sanaullah, there is no problem dear, you can do it that way. So why you want me to change my solution and do according to your way? You can do that way, it's the same thing. Faizan, you are also asking the same thing, that can we do it like this way? Obviously, solution patterns can be different. There is no need to follow the same solution. If you want to do it directly, you can. Sana, there is nowhere 2,000. In calculation, depreciation is 5,000. And it's giving tax benefit as 20%, 1,000. So this 1,000 we have taken as inflow. Okay. So in option 1, these are the 5 cash flows. Now you should net them all to get net cash flow. So net cash flow is $34,000. Net cash flows need to be multiplied by discount factor. Now for discount factor, either you can use the WACC of 8% or you can use the cost of borrowing of 4%. Both are allowed. Either you can use the cost of borrowing of 4% or you can use WACC of 8%. Both are allowed. Examiner has clearly mentioned it. Just to make sure that the answer matches with the examiner's answer, I'm using 4% factor here. You can also use the WACC 8%. Okay, the factors are 1 from the table, 0.962, 0.925, 0.89, 0.855, and 0.822. Net cash flows into discount factor gives us present values, and if we net them all, we get NPV of option 1. Net all cells. -477, sorry, -13,000. -20298. You can copy and now ask any questions, because I think a very significant issue is regarding the tax allowable depreciation, because there are some students which who basically don't know exactly the concept of TAG and depreciation, because the majority questions were from 3 or 4 students regarding that. So for the sake of their understanding, I will repeat it once again. I just gave this 10,000 profit as a hypothetical figure, that for example, if you say your profits are, let's suppose, how this 1,000 saving came. The easiest way is that depreciation is 5,000, so it reduced profit by 5,000 and reduced tax of 20%, 1,000. Emission tax is 600, it reduced profits by 600, will reduce tax by 20%, 120 benefit. Okay, because tax reduction is a benefit. 5,000 depreciation, reduce profit, so reduce tax by 20%. 1,000 is a tax saving, it's a benefit. Same for emission cost. But hypothetically explaining, let's suppose your profit were 40,000. So in normal circumstances, you have to pay 20% tax on 40,000, that is 8,000. Depreciation of 5,000 each year, right? 5,000 each year as per straight line will reduce your profit by 5,000. So from 40,000, your profit will become 35,000. And now you have to pay 20% tax on this 35,000, that is 7,000. So see, because of depreciation expense, your tax was becoming 7,000 from 8,000. That means saving of 1,000. This is tax benefit. Yes, one capital allowances is relevant. That's what we have taught in the lectures to you as well. You need to be attentive regarding lectures. I told you that discount factor can be 4%, discount factor can be cost of capital 8% as well. Both are allowed. Just for the sake of matching with examiner's answers, I am using 4%, but you can use 8% as well. No worries in that. So I think those students who didn't have information about TAD, hopefully this written material may have helped them to understand the stuff. Josefa, any information which is published by ACCA, I cannot answer you regarding that when it will be published. So it's better you contact ACCA. Okay, now we have calculated the NPV of option 1. Now, in order to decide which is better, we need to have NPV of option 2. And then we will decide which is better. Now let's read option 2. The vehicle could be leased for a period of 4 years for a payment of 6,000 per year payable at the start of each year. The lessor will pay the CO2 tax. Since I am the lessee, I am not paying emission tax, so I won't record it. Lessor will pay, that's his issue, I am the lessee. Lease payments are tax deductible, so again, you will get tax benefit on that. And hawkers after tax weighted average cost of capital 8%, tax rate is 20%, 1 year in 8 years. Okay. So option 2, when you are finding NPV of option 1, record all cash flows of option 1. When you are finding NPV of option 2, record all cash flows of option 2. So machine could be leased for 4 years for a payment of 6,000 per year, payable at the start of each year. Lessor will pay the CO2 tax. Lease payments are tax deductible. Hawkers after tax cost of capital is 8%. So in option 2, you are leasing for 4 years, right? So again, 0, 1, 2, 3, 4. Okay. Vehicle could be leased for a period of 4 years for a payment of 6,000 per year payable at the start of each year. So payment is 6,000 per year. In normal case, for 4 years, 6,000 per year means 6,000 per year, 6,000 each year, 6,000 each year, 6,000 each year. But the problem is they are paid at the start of each year. So 6,000 per year for year 1 is paid at the start of year 1. So you should all remember that in NPV calculations, if some payment is made at the start of each year, that means for year 1, the lease payment is made at the start of year 1, you should record this outflow in year 0. The year 2 lease payment at the start of year 2 should be recorded in year 1. The year 3 lease payment should be recorded in year 2, and year 4 lease payment in year 3. Okay. Does everyone know this point? That if the question states lease payment are 6,000 per year and it's paid at the end of each year, so you should record in year 1, year 2, year 3, year 4, because end of each year means record normally. Year 1 lease payment in year 1, year 2 lease payment in year 2, year 3 lease payment in year 3, and year 4 lease payment in year 4. But if it states that lease payment is at the start of each year, so year 1 lease payment at the start of year 1 should be recorded in 0. Year 2 lease payment at the start of year 2 should be recorded in year 1. Year 3 lease payment at the start of year 3 should be recorded in 2. And year 4 lease payment at the start of year 4 should be recorded in 3. I won't record the emission tax because that is paid by someone else, not my cost. But lease payments are tax allowable. That means again, these lease payments are tax allowable. They will reduce my profit by 6,000. It's an outflow, so they will reduce my profits by 6,000 and will give me 20% tax benefit, that is 1,200. 200 because they're tax allowable. That means they will reduce my profits by 6,000, resulting in reduction in tax as well of 20%, 1,200. Had the tax been in same year, I would have recorded in 1, 2, 3, 4, but since it's in arrears, it's a benefit. Arrears means recorded in 2, 3, 4, and 5. We net them all. These are the only two cash flows we get. Net cash flows. Negative 6,000, negative 6,000, negative 4,800, negative 4,800, negative 4,800, sorry, 1,200 and 1,200. These needs to be multiplied by discount factor again. %4 or 8%, both are acceptable to match the answer. I'm just using 4, but in my classes I used 8%, but here just to match using 4%. You will get present values, and once you net them all, you will get NPV of option 2. $18466. Okay, you have NPV of both options. One is giving you negative 20 and one is giving you negative 18466. So which is better? Company should go for leasing. Okay, you can copy, and if any questions you can ask. I have few questions. Mohammad Arslan, your question is that borrowing cost is irrelevant NPV. The outflow and inflow is irrelevant, not the percentage is irrelevant. So either you take the percentage or you take the cost of capital, because that's 4% would have been included in the cost of capital of 8% as well. So that's why both are allowed. Ahmad Hayat, the difference between finance and operating lease is that if maintenance cost, and here maintenance cost is something like emission tax, it's borne by me, lessee, then it's a finance lease. But if it's borne by the lessor, then it's an operating lease. Lessor Aisha is the person who is giving you the machine like the bank, and lessee is the person taking it. Yes, Sanaullah, there is a difference between finance and operating lease, and the only difference is that maintenance cost is borne by lessor in operating lease and by lessee in finance lease. Yes, maintenance cost is also a tax benefit. Nabil, your question answer will be different. If you use 8%, yes, your answer will be different, but your decision will be the same. Sanola, there is a question in F9 Kaplan kit. The question name is Liminger PLC. So it's better you see that question. Here it was no mentioning of finance lease or operating lease, only lease was mentioned, therefore we used normal lease only. Yes, Faizan, if lessee would have paid, then we would have considered it. Ahmed, this is a very strange question. How we will know we will lessor or lessee? Now, when you are purchasing a machine, that means you are needing machine. So if the company is needing machine, company will always be lessee. There is no possibility that you can be a lessor. You are a company uses machine, and you are a lessee. So it's a very strange question. Yes, Aman, no issue in that. Yes, Nabil, obviously you will use the same discount factor at both places. Okay, I am sure that the students who have taken my classes, they wouldn't be confused with this particular point. However, there are some people asking me this point that if lease payment is in 0, 1, 2, 3 and tax is in arrears, so why is 20% saving of 1200 not coming here? This one here, why you are starting from year 2? Now it's a great logic behind this. There is a great logic behind this, and I want you that people who don't know this logic, they can take it. You see, it's a 4-year life, okay, and the lease payment is 6,000 per year. So officially the lease payment should have been like this: 6,000 per year. For year 1, 6,000 cost; year 2, 6,000 cost; year 3, 6,000 cost; year 4, 6,000 cost. Officially it should have been like this, because lease payment is 6,000 per year. So for year 1 it should be 6,000, for year 2 it should be 6,000, for year 3 it should be 6,000, for year 4 it should be 6,000. And the problem was, these payments were made at the start of year 1. They were made at the start of year 1. This payment was officially made at the start of year 1. This payment was made officially at the start of year 1. Because NPV calculations have a problem. They don't have discount factors for year start calculation. NPV calculations have a problem. They don't have discount factors for year start calculation. Therefore, anything at the start of the first year was recorded in previous year. But taxation authorities don't consider this problem. They say it's your problem, that this 6,000 was made at year 1 start. You had a problem, NPV had a problem, that it was at the start of year 1, so we recorded in 0. But in reality, it was at the start of year 1. You recorded in 0 because of your problem. In our eyes, it's at the start of year 1. So if there is no delay in taxation, we will give 20%, 1,200 benefit in same year. And if taxation is in arrears, we will give 20% benefit, 1,200 in year 2. That's why payment is being shown in 0, but the benefit is being shown in year 2. Repeat. This 6,000 lease rental of year 1 was officially paid at the start of year 1, right? It's written at the start of the year, so start of year 1. Your NPV calculations have a problem that they don't have discount factors for year start. Therefore, we recorded it at the end of previous year in 0. But we just recorded it in the year 0. Officially, it was at the start of year 1. So taxation authorities say, we won't consider your problem. It was occurred at the start of year 1. So since there is arrears, we will give benefit in year 2. Okay. Hassan, it's not possible to use different discount factors at both places. Either compare it with 4% or 8%. You cannot use different discount factors at both places. Ahmed, the class will end when this question is over. Part B of this question. Discuss 2 reasons other than possible after-tax cost advantages why hawker may choose to lease rather than buy. So basically, you just need to mention 2 reasons why hawker may choose to lease rather than buy. Again, I will write the points and a person copies the points and for your help shares on the group. Don't make fun of him. Okay. There was too much taunting going on with each other in the group. That's why I have restricted the messaging portion in that. So, two reasons. Obviously, I will just write the reasons and elaborate them, and you can elaborate it on your own and read the examiner answer must. People are asking, where is the examiner answer? You should know it's on the website. So discuss two reasons other than after-tax cost advantages. No need to mention cost advantages that leasing is cheaper. Other than cost advantages, two reasons why we choose to lease rather than buy. Okay. So one reason why hawker may choose to lease rather than buy. Whole cash is not injected once. Okay. In buying, all cash goes at once. In leasing, whole cash doesn't go. How you can elaborate it? This is advantageous for the company, that if you keep cash with itself rather than investing whole cash in the machine, you can invest this cash somewhere else to earn benefit. You can invest this cash somewhere else to earn benefit. So this can be one advantage why a company chooses leasing, that whole cash is not injected once. You can save cash and generate income by using that cash. Okay. Second, can take advantage of technological changes. You see, if you buy a machine and suddenly technology changes, if you buy a machine and suddenly technology changes, what you can do? You have bought it, you can do nothing. But if you have taken something on lease and suddenly technology changes, you can eliminate the lease contract and go for the new machine. So these are the two good reasons why a company may choose leasing rather than buying. You can write these 2 points, and any other points are most welcome. So much instructions by students. Immediately go to the next part. Please quickly finish the class. Another message. Why? I'm not understanding why. Okay, last part now before ending the class. Discuss 3 advantages of using NPV rather than IRR. It's a golden requirement. That 3 advantages of using NPV over IRR. Okay, you can directly learn them from the book. Remember, this is not a case study requirement. It's just a random requirement. Discuss 3 advantages of using NPV over IRR. So in the study text, there are advantages of NPV, disadvantages of NPV, advantages of IRR, disadvantages of IRR. Okay, so you have to write 3 advantages of NPV over IRR. In the text, it's mentioned NPV is an absolute measure. Absolute measure means value-based measure. Whereas IRR is a relative measure. Relative measure means percentage-based measure. NPV gives answers in dollars, whereas IRR gives answer in percentage. Remember, the real dollar value is always more easy to understand for a person. If I tell you that a project is generating return of $2,000, you will understand it easily. But if I say a project is generating return of 10%, you won't understand it easily, because you will start thinking a project is generating 10% return of what? Of sales, of costs, of profits, of investments, so many questions. But if I say that project is generating return of $10,000, no other question. Everybody is clear with it. So NPV has an advantage. It is an absolute measure. IRR is a relative measure. Okay. First advantage of NPV over IRR. NPV has a proper approach. Record all inflows, record all outflows, a proper approach. IRR is a trial and error approach. You see what you're doing in IRR. First NPV at 10%, then randomly increase discount factor to 15% to get the second NPV, or reduce it by 3% to get the positive NPV. It has a trial and error approach. It has no formal approach, whereas NPV has a straightforward and formal approach. Okay. Okay. So this is also an advantage of NPV over IRR, that it has a straightforward fixed approach. IRR has a trial and error approach. Some people increasing by 5% to get the other NPV, others increasing by 6%, no formal method. Okay. Third advantage, a project always has one NPV, but it can have multiple IRRs. Now, whenever you calculate NPV of project, there has always been one NPV. Okay, either positive or negative. But projects usually have more than one IRRs, especially in case of non-conventional cash flows. And when there are more than one IRRs, it obviously makes difficult for the person to take decision. So these are the 3 advantages. Again, my advice is read the examiner answer to get a more crystal clear idea. Okay, so today's class has ended now. And if there are any questions, I will be here for the next 5 minutes to answer them. We will meet in the next class now. Okay, and please ask any questions if you have. Thank you. Jawad, as far as your solution is concerned, your question is concerned, there is no deep explanation to Part C. It's just a rote learning thing, advantages and of disadvantage of NPV IRR. It's not a conceptual requirement, it's a learning requirement. Yes, Fazan, you are right. Maria, the WhatsApp group links have been shared. And Irshad, I told you that whatever you are expecting, that cannot be taught, okay? Because this class is doing past papers and revision. If you have problem in any area and you want to discuss separately, you should message me on WhatsApp. Sanaula, please message me on WhatsApp. Yes, Vanya. Sana, just read the examiner answers. That's the best strategy. Those who have been unable to join the WhatsApp group, I have shared my number. Please message me on WhatsApp. We will add them. Okay. I have shared my number. Please message me on that number. Trial and error approach. Amna, it's trial and error approach. Okay, then see you all. Any further questions we can discuss on WhatsApp. Thank you.